Numbers matter. In business, black numbers are good, red numbers are not so good. Back in the onset of the internet, Pets.com was a popular business that even garnered the attention of Amazon. It raised a healthy $82.5 million in their initial public offering, Amazon, of course, owning about half of that. Unfortunately, in less than 2 years, this seemingly profitable business went bankrupt. How did this happen? There are a number of reasons for this, but one thing is for sure, the accountants saw it coming. In this video, we will take a look at 3 businesses who wouldn't listen to their accountants and stared bankruptcy in the face. Toys R Us. This first example personally crushes my soul. I can still remember being a young child walking into a Toys R Us store and seeing toys literally everywhere. I literally thought I died and went to heaven. But that was almost 40 years ago. I've changed a lot since then, but Toys R Us did not. Rather than make technological changes towards online sales and switching from physical toys to virtual games, Toys R Us continued to pack the stores full of toys like they did for the last 70 years. $5 billion of debt stared at the company while sales declined. The accountants surely started updating their resumes and began applying for new jobs. In the end, Toys R Us went bankrupt. We'll miss you, Joffrey. Freddie Mac and Fannie Mae. Let's take a $5 billion debt to an extreme level. Freddie Mac and Fannie Mae, prominent mortgage companies, were the victims of their own bad business decisions and accounting errors. While Fannie and Freddie were being careful in choosing responsible people to give home loans to, other companies like the Lehman Brothers were handing out predatory loans to irresponsible people to make profits. In doing so, they began to steal large numbers of Freddie and Fannie's customers. Freddie and Fannie used to have over half of all of the mortgages in the United States, but the accountants soon declared they now had more loans than income. Desperate, they began to follow the trend of investing in risky loans to stay afloat. As more and more people with bad credit began to default on their mortgages from these risky loans, the Freddie and Fannie family began to fall with many other mortgage companies, and the housing market began to collapse under the weight of debt. Fannie and Freddie carried the bulk of the debt with $5 billion. Had the government allowed them to go bankrupt, $5 trillion in loans would have gone unpaid worldwide. Without the government stepping in to bail out these companies, a global economic disaster would have ensued, equivalent to having Great Britain or Japan going bankrupt, but it would have been worse. Banks who invested in the US from all over the world would not be able to afford to lend to anyone. Schools wouldn't receive bond money and they would have to close. Businesses couldn't borrow to expand. The economy would cease to a halt worldwide. Strict regulations for loans on mortgages soon followed to prevent predatory lending from occurring into the future. And to this day, we have the economic phrase, too big to fail. Kmart. For this last example, we'll take a look at a company that didn't listen to their accountants not just once, but twice. The story of Kmart includes not one story of bankruptcy, but 2. Between Amazon, Walmart, and Target, Kmart was taking a beating financially. The accountants could do nothing about all of their debt, only to begin updating their resumes. It also didn't help that the corporate leaders were lying to investors and stating that all was well while they were spending a $5 million loan on airplanes, houses, boats, and other luxury items. And so, predictably, Kmart was forced to go bankrupt. A wealthy investor, wanting to capitalize on all of that real estate, decided to purchase the Kmart empire and merge it together with Sears. Many stores were closed down that were unprofitable, and accountants finally started seeing profit for the first time in 3 years. Unfortunately, that didn't last long. Christmas after Christmas resulted in disappointing sales. After hundreds, then thousands of stores began to close, Kmart was again filing for bankruptcy. Creditors were demanding liquidation left and right to regain some of their money back on defaulted loans. To this day, fewer than 35 stores remain open after their peak of 2,500 stores. It's important to keep accurate sales and expenses data in your ledgers. Accountants are vital in assessing the creditworthiness of businesses when securing loans. In addition, businesses use this information to make choices about how to disperse limited resources within the company. Good accountants can make strategic decisions to keep the company alive in difficult financial times. However, as you have learned, without good company management, accountants are nothing more than corporate psychics of the doom that is to come.